Hey everyone, this is Andy Michael, Chief Investment Officer with Seven Springs Wealth Group. Today I want to discuss some top of mind topics that we're discussing with clients and internally as we go into year end. Some of those topics include, how can markets be at all-time highs right now? I want to share some takeaways I had as I attended the lunch that Jay Powell presented here in Nashville. Some thoughts around the election, a common one that we're hearing more about from clients and discussing ourselves, the U.S. debt and deficits, and some actionable ideas as we go into. So how can the market be at all-time highs right now, especially when we have all the geopolitical events going on in the Middle East, in Europe, and in China, with the election upcoming, these huge deficits the U.S. continues to run, the catastrophic weather that's been terrible to continue to watch on the news, and all the labor strikes we've had of recent. How can markets be at all-time highs right now? Well, past the front page of the news, what we see is a Goldilocks economy backdrop right now. The 2-2-4 economy. That's 2 to 3% inflation, 2 to 3% positive real GDP growth, and 4% unemployment. That is an economy we haven't seen in the past 5 years, really in the 2020s, and yet we're here now. We're seeing interest rates lower, not higher. Again, another favorable tailwind for markets right now. We are seeing companies start to show some earnings growth and projecting some earnings growth going into Q4 in 2025. And look at the market breadth over here. You can really see it in this quarter to date over here. You know, the market had been driven mostly by the NASDAQ, Russell 1000 growth. These are those mega cap AI type companies. Now we're seeing both small caps, Russell 2000, value companies, Russell 1000 value, and international companies, all really beginning to participate in this rally. So market breadth has picked up. So even though it feels surprising sometimes that the markets are all-time highs, the true underlying backdrop of what drives markets has been very, very favorable. Some takeaways from lunch with Jay Powell as he presented in Nashville on Monday. I was fortunate enough to go to the conference. This is actually my picture I took of Chair Powell at that meeting. And so what I heard from my ears to now you is that Chair Powell and the committee are looking at 2 rate cuts between now and year end, based on what current economic conditions present at this time. So I would expect a 25-point cut in November and 25-point cut in December based on what we know today. Jumping down to 0.5, it is very data dependent. He made that abundantly clear. They are looking at real-time data and will adjust accordingly based on what is coming in on both inflation and on the unemployment side. The committee, as we just talked about, that Goldilocks economy, they're very happy with where they are right now. It has taken them 5 years to get to this place, from the pandemic to inflation, from extremely high unemployment to extremely low unemployment, from deflation during the pandemic to 9% inflation in 2022. It has been all over the board, and they finally got the economy in this Goldilocks type scenario, and they're going to do what they can to keep it there. They're not in a hurry to cut rates. I think that was made clear as well. But once more, they're going to do what it takes to keep this economy in this what they consider healthy backdrop. Let's talk about the election a little bit. And so these are a couple of points I really wanted to hit home today. You know, the year after the election, over the past 4 election cycles, have been very, very positive in the market. A lot of different reasons and backdrops for each one of those. They each have their own story as to why the market was so strong. But I certainly think a component, not the component, but a component of that is just the fact that the election uncertainty is removed. And so then market investors, CFOs, businesses can start moving forward knowing what the White House looks like for the next 4 years. Now today we are starting at a much higher valuation than some of these past years, so certainly don't know if that's going to be in the cards for 2025. But nonetheless, once you get past an election, by and large, that's typically a positive for the markets, all things else held equal. And then, as we like to say in Tennessee, if you don't like the weather, wait 5 minutes and it will change. That's what the Washington, D.C. administrations have looked like over the past several years. What I'm really trying to show here is every 2 years, the administration makeup between Congress and the White House continues to change and evolve. And so what that does is it doesn't give any one side too long or too much power to get anything through that is altering for a long period of time. And so whatever happens in this election, a good probability is that it'll be different again 2 more years from now. You can see here from our friends at Springtide Partners just some of the different policies that they expect to happen based on each of the potential scenarios of both President and Congress. And so I'm not going to jump into too many details here. You can read this on the page. Really, my bigger point here is that the probabilities, this was as of September 18th, still remain largely balanced across all 4 scenarios. So no one scenario is overtaking markets at this point in time. I think you're really seeing that play out. Let's talk about the debt and deficits. It is one that's coming up both more in conferences and market updates I'm reading, coming up with client conversations. So the U.S. debt as a percent of GDP is now at around 120. Clearly, that is much, much higher than we've seen throughout history. It is down from where we were in the pandemic when it was all hands on deck for fiscal stimulus, but it is still a trend that is very, very high. So it is one we're keeping an eye on. With that, deficits as well. So we're still at 6.3 or so percent of the last read, nowhere close to a balanced budget. In fact, I wouldn't expect to get close to a balanced budget with what's going on in Washington and what we're hearing from both potential candidates. So where does that leave us? I think that's the bigger thing here. When should we be worried? 200% debt to GDP. A Wharton study found that that's about the level where it becomes legitimately unsustainable. Again, we're at about 120%. So still a very long ways away from that 200% level, but it's just something that I'm keeping in the back of my mind as we continue to see where the debt to GDP levels grow from here. Higher long-term treasury yields. So if the market starts pricing long-term treasury yields at higher rates, that would be a strong sign of the level of concern and risk that we're seeing in markets. Right now, that's not happening. And then sustained inflation. So if you continue to spend more than you're bringing in, you continue to print currency into the U.S. and global markets, then you would expect to see some sustained inflation. So we just had inflation at 9, brought down back to 2. So I wouldn't call that sustained yet. So far, the monetary policies have worked. But if we got to a point where we continue to see that inflation at higher levels, I think that would be an alarm to say the debt has become a material problem to markets. So how do we resolve it? Grow, inflate, or austerity. I'm going to quickly say number 3 seems to be off the boards with both candidates and the appetite in White House to cut any spending. Not seeing that at this point in time. So that means either the economy can grow, right, keep that debt to GDP level in check, or as we just talked about with alarms, you can inflate the debt away, which partially has already happened, right? We've had cumulative, probably about 20-25% inflation over the past 5-6 years. So that total level of debt and interest payments is already worth 20-25% less than it was a mere 5 to 6 years ago. So those are the ways to resolve it. So let's talk about some actionable ideas. Risk check and needs-based rebalancing. This is when you want to assess risk in your portfolio. When markets at all-time highs, that's when you want to start assessing, is my risk level right? Especially as we've had a couple of strong years in the market, you may find that your risk budget has increased whether you meant to or not. So it's a good time to stop and reflect on that. And needs-based rebalancing. This is the time to start getting those cash needs that you're going to need over the next 6, 12, 18, even 24 months set aside. Make sure those are in good orders. Strategically book some profits from some of the gains that we've seen in markets based on what you need, right? Not just doing it to do it, but based on what is coming down the road as you're thinking about your capital needs over the next couple of years. We're beginning to see opportunities in profitable U.S. small caps. Some of these tailwinds we just talked about, the Goldilocks economy, rates coming down, the dominance large cap stocks have had over U.S. small cap stocks over the last couple of years. All of that seems to be tailwinds to us for profitable U.S. small cap businesses that have underappreciated growth, a place we're seeing opportunity right now. Starting to see emerging markets, one of the lowest valued places left in global markets, and yet we're starting to see some major catalysts coming out from some of the larger emerging market economies that could really become a boost and a tailwind to emerging markets. One of the few places that's been largely unloved over the past few years. Energy infrastructure, we've talked about this one over multiple quarters now. And finally, high yield money markets. So based on where we're seeing banks starting to already cut rates to high yield savings accounts. I personally saw one email come through today for rate cuts coming on what banks are paying savings accounts. Remember, that's an expense to the bank, so they're pretty motivated to cut that yield if they can. And Treasury bills are already pricing in more cuts than what the Fed just communicated to us this past week. And so I think collecting the most yield you possibly can in high yield money markets is the right place to be for those excess cash reserves. So that's it for us today. Really appreciate your time and listening. Thank you so much for watching, and have a great day.